yeah, I will want to get start on the Zoom also. So for everyone who is watching through the app, please wait for a while, yeah. Let me set up the other platform. Hello everyone. Let me check if everything is going alright. Okay, it seems like everything's good. And we shall get started on our session right away because this is actually not a
recording in progress.
Not a paid version of Zoom, so we don't have much time left for that. So if you can hear me loud and clear, do let me know. If the voice is not clear, do let me know also, so I will just control a bit. It seems like everything is alright, then we shall get started on today's topic. And yes, today actually we are going to talk about the index fund DCA. So when it comes to DCA, it means that dollar cost averaging. So I believe that maybe some of you already know about what is dollar cost averaging, and it's about a strategy for a long-term investment. And it might be kind of boring, but it can just guarantee you that in the long run, your money can eventually become more and more, and then it will just outperform the market and then give you a better return compared to your own investment and your own trading. Because some people come to the financial market without many knowledge, and then at the end they just lose up all their lifetime savings. So this is actually one of the strategies that can make you at least better than the market average performance. And at the end of the sessions, we will also share about what is the index here that you can pay attention to in today's under Trump policy. So under Trump policy, there's few index that you can pay attention to, and that might be a little hint for you to just kickstart on your index fund dollar cost averaging investment. And since there are so many index, right? So if you are just don't want to be so picky, and then you want to just get involved in the market and then have a minimum return, then I would suggest you to just put your money into S&P 500, because that one is the most stable one, and then it can ensure that the fluctuation is not that much, but also the gain might not be as much as the other. So the beauty in this index fund dollar cost averaging is about picking the right asset, picking the right index. And yeah, so maybe we can just get started on today's topic. So the aim goal of the dollar cost averaging is about no longer miss the next bull run. Many people come to the financial world, and then even though they're involved in the bull market, but at the end they didn't bring anything left the table. They just lose all their life savings in the bull run because they make their profit easily in the bull run. And then this is one of my real life cases, not mine, but one of my students. So he makes some 700 a few hundred thousands in the market, but even though it's in a bull run, eventually he just lose up all the profit back to the market instead because of some psychology problem and whatsoever. So this is about the dollar cost averaging is about to make sure that you didn't miss the next bull run, and then you can just keep on participate on the market movement, and then to make sure that the gain in your savings, the gain in your money can outperforms the inflation in the market. if you are not aware of the inflation in the market, the inflation in the market is about 4% per annum annually. So let's say that you buy a phone today with $100. Just an example, you buy a phone with $100 today, then with the same quality, and in the next year, it might cost you $104. That is what inflation means. But your money in today, $100, in the next year is still $100 or even smaller. You know, so when we come to investment, we just want to make our money work for us, and then eventually the minimum requirement is to surpass the inflation, and then your final outcome is to let you can retire earlier and let your money to generate more and more for you and to support your life and then make you financial freedom. And then this is one of the way to do so, but this is a very tough way to do, and it might need you to be have a very strong discipline, strong mind, and take you some time to do so. And yeah, so it's still the same disclaimer as usual. This is just for educational purposes, and this is not for any trade calls and any other signals given. Okay, so this is just for educational purposes, and we are not going to collect any of your personal information or your money. So if anyone comes to approach you with that kind of purposes, do be aware that might be a scammer. They're using our name. Okay, and just give a little bit introduction of my own. I'm Hu Junlo, and I'm a senior financial trainer and analyst in Newsmark. And let's speed up for today's classes. So for the long-term investment, today we are talking about the DCA in index fund, and this is actually one of the strategies for a long-term investment, not a short-term technical analysis thing, but this is a long-term investment. For example, the S&P 500 has historically averaged about 7 to 10% annually. This is taken for 10 years record, and then this is about 7 to 10%. It might not be a lot, but at least it surpassed the inflation of 4%. So you can make sure that your money today can work a little bit more for tomorrow, a little bit more in the future. Okay. So according to the study by Darbar Inc., the long-term investor typically outperforms the market traders and even many mutual funds managers due to lower transaction costs and reduce the sentiment biases. So the main focus here is he outperforms the broader market, outperforms majority of the market players, and this is because of lower transactional costs. The quantity of your call, the quantity of your trade has been reduced to a minimum, like once per month, or even smaller. So it can reduce your transactional cost and can let your platform didn't earn that much from you, and it can also reduce your sentiment biases, which means that if you are bullish in the global economy, then you can just always go for bullish instead of you just watch on the chart and then you have to identify whether it will go up or down. But when you just scroll up from the chart, you can see from the whole macro of economic view, and you will know that in some years, in few years, the world or the specific sectors or market will go up. So you can reduce all those noises from the short-term trading. And this is about frequent trading, which is also what we call a short-term trading, like a day trading, a swing trading, and scalping, even scalping. So the study has shown that 80 to 90% of the day traders lose money, and only about 10% of them are able to make consistent profit in a long term. Even me, I have been doing day trading for about 6 years, and I only start to get profit in recent 2 years. previously I've been keep on losing and losing for 4 years instead. And yeah, there's actually nothing special about being a profitable day trader, but it's very difficult on the mentalities and also on the disciplines side. So you can see that the studies already show that majority of the players do lose money in day trading. So why are you still going for day trading? Are you believing that you are the one, the chosen one? I don't believe so, because I'm not a lunch-based person. Actually, I'm quite a rational people, and then I believe in numbers and figures. Okay. And also a study of a day traders in Brazil found that only 1% were profitable after 5 years of active trading. So even though you have become a profitable day trader, are you able to make sure that you are able to keep on consistent profit throughout all the years, supporting your life, and then even make your life better? There is a lot of uncertainty in that. So the study there show only 1% are able to survive. So you can see that this market is actually very cruel in terms of the survival rate. Okay. So why the long-term investing has a better chance of winning comparing to trading? A higher winning rate, about 60 to 80%, is due to patience, compounding, and the long-term resilience of the market. So just like Warren Buffett, when he believes that the US is going to become better and better, but America become great again. So he just find the diamond in between, and then he can just invest in those and grow together with the company. So he might need to wait for a few years, but at the end, he is now a very successful investor. And the second point is the low win rate, about 10 to 20%, is mainly due to high competition, high cost, and the difficulties to just consistently and accurately predicting the market movement. So when you are doing a long-term investing, you don't need to time the market. You don't need to just catch the bottom, catch the top. You don't need to catch the sign of the reversal and the perfect entry point. This is also what we call the sniper entry point. So when you are doing long term, you can just put in your money, and then when you come back after a few years, you will just find that the entry point actually doesn't make any difference. Maybe just a few percent difference, but it doesn't hurt your portfolio that much, or it doesn't affect your portfolio that much. So this is about long-term investing. The power of the long-term investing actually comes from a compound return. When you're investing into the stock and index, you might get dividends, and then you can keep on regenerate all those dividends, and then you put all those dividends back to the asset, the stock. Then you can eventually create a higher and higher amount in your dividend, and eventually it might surpass your salary, and then that is what we call a financial freedom. You can now rest in your house doing nothing and maybe retire earlier, and then the money will just keep on pounding into you, flowing into you, and then you just keep on increasing and increasing. And the second pro of the long-term investment is it can reduce your stress due to the daily market fluctuations. If you are being a day trader before, you will experience the feelings that day trading is actually quite a high tension job to do so. You need to keep on watching the chart because you are afraid of missing out some trade signals, and your mood will swing according to the price action, and that is actually not a good thing to talk about, a good thing to experience. So by doing a long-term investment, you can actually reduce your stress, and then you can just enjoy your life, and then leave all those money do their work. Okay. And the third one is there's no need to time the market. Just like I said, you don't need to just catch the bottom. You just need to ensure that you are involved in the market. So in the long run, you will get profit. It's just a matter of the money is big or small. But believe me, it doesn't make a very huge difference when it comes to this. So why we are picking a stock and ETF for long-term investment? Because first one, this is very easy to approach. And if you don't know about the stock analysis, and maybe you can just pick for ETF instead, because some of the ETF will just cover a whole sector or the whole industry, or even the S&P 500, the Nasdaq 100, they will just cover the top 500 stock or the top 100 stock in the market. And in that case, you can just grow together with 100 company altogether, or you can grow together with 500 company altogether. So even though one of those companies maybe bankrupt due to some accidents issues or some corrupted issues, and it doesn't affect your portfolio that much, because the other company, the remaining 99 companies, will keep on supporting the price, and that is what we call a diversification. So by investing into the ETF, you can make sure that your risk is diversified, and then you can avoid the risk of being bind to one specific company, and then if that company goes wrong, you go broke. That is the case that you want to avoid. And the second thing is, stock and ETF, sometimes it comes with dividends income and capital appreciation. So there's two types of revenue that can generate inside this long-term investment. Let's go through it all together, yeah? So when you are doing a long-term investment, this is an example of buying a dividend stock. You buy at $1 per share for a dividend of 2 cents per share. So that will make it a 2% dividend yield. But what if the price of the stock go from $1 to $2? So your capital get double, right? And the double capital is what we call a capital appreciation. So that make it 100% of capital appreciation. And the dividend yield is still 2%. That is what makes it different. And now the dividend that you get is 4 cents per share. Instead of the 2 cents per share previously, you are now getting 4 cents per share. So actually, to your portfolio, you are not earning a 2% dividend yield, but you are making a 4% dividend yield, because we are calculated based on the initial capital that you put in. So when the capital when the price keep on going higher and higher, all those two are actually will just helping the others, and then it just keep on increasing altogether. When the capital appreciation becomes higher, the dividend that you get is higher, and the dividend you get is higher. You can collect that dividend and invest back into this specific stock, and then it can make your capital appreciation even become higher. So you can now see the snowball effect that it keep on growing and growing. And then, yes, this is the principle when it comes to a long-term investment. First thing, start earlier, because this one actually takes time for it to take effect. So if you start earlier, then you can get retired earlier. Because when it comes to snowball effect, right, it's all about compounding. So when you start earlier, then your snowball get to roll earlier, Then that is the case that you will have a one step advance of the others. And the second thing is diversification. Make sure that when you come to long-term investment, you don't put all your money into one basket. Don't put all your money into one specific stock. So let's say if you put into SMCI, and then now it gets kicked out of the Nasdaq 100, and your investment will just barely go to zero. That is the case if you just heavily invested into one specific stock. So when we come to a long-term investment, we want to make sure a long-term success. That's why we are doing a diversification. If you have not experienced in the stock analysis and all those things, just choose ETF instead. And by choosing ETF, there's still multiple ways to play around. You can choose the ETF for different things. Let's say Nasdaq and the next step 100 for the US market, or the gold ETF for the commodity, or the Bitcoin for the Bitcoin market. So there's many ways to play around with that. You can also invest into the ETF for specific sectors. Let's say you're very bullish on the tech industry, the technology industry. You believe that technology industry, under Trump's policy, under Trump's help, will grow even bigger when comparing to the others. So you can just choose the tech ETF instead of the general ETF, and in that way, your risk gets diversified, and you can even create a higher return. And the third point is be patient, because these things take time to do so. When you are doing a long-term investment, you are unlikely to have a leverage effect, because you want to be safe first, then only we will talk about the return. So when there is no leverage effect, you need to be patient to let the effect take place. And the next point is reinvest the dividends. So when we get the dividends, you can either take the dividends and buy yourself a coffee, buy yourself a car, pay the rent, and pay your utilities. You can do so, but I would recommend you to just use the dividend, reinvest back to your own investment, the original investment, and then let it help itself to become great and better again. I believe that if you miss that coffee today, you won't die, right? So, and that little money may become a very huge effect in the future because of the snowball effect. And the last point is be consistent. When we want to do a long-term investment, we will just keep on inputting our money bit by bit into it, and then we need to be consistent in doing so. Either way, or you will just give up in the middle, and then you can't enjoy the fruit of the success. And this is the research tool that can recommend to you. You can use the Yahoo Finance, the Morningstar, the Bloomberg to watch on the market data or the news. Or you can even read the financial reports for an in-depth understanding of the company financials and the operation status. And you might even need to do a fundamental analysis for the valuations and the projections. So this is actually the step of the fundamental analysis, to just find the diamonds in the market, and then you can just pick up the stock at the right valuations, and then you can just exit the stock and then go to the other when it arrives at your projections in the future. Let's say I will see that maybe Tesla will just drop back to 300. That is my valuation, and then I will just waiting for it to drop until that level, and then I will just get into the market, and then my projection, let's say, is 600 in the future, and when it arrives 600, I will just exit the market, and then I will just go for the other stock. But you need to make sure that you are picking up the diamond. When I say the diamond, it means it might be a top tier company, or you will need economic moves. When we are talking about economic moves, this is actually the mechanism that protects your share difference from the other company. So let's say iPhone, the economic mode is very special. The economic mode is called what we call a switching cost. So if you use the iPhone iProduct before, there's something that called the iCloud. So every of your information, your materials are to be storing in the iCloud. So when you're switching across the iProduct, you don't need to make very troublesome move to just save the information from your old phone and then remove to your new phone, and then you need to just switching the SIM card and or the memory card and whatsoever. So if you are switching from the I product to an Android product, the switching cost will take place. So that makes you when you want to avoid this kind of troublesome thing, you just take on to I product, and that is what we call the economic mode of the Apple. So this is switching cost, and that is the economic mode of the I product. And there's also the other, like Costco. The economic mode might be the business scale is big enough, so he can just getting a lower price from the supplier. So when you are having a bigger scale of your business, you can just order a huge lot of the goods from the supplier at once. So at that time, you will have the bargaining force. You will have the bargaining power, so you can talk on the price. You can just push down the price and make the supplier kneel down to you, give you a lower price. So that is also one of the economic mode that we call. And let's move to the second. If you are not aware of the business mode, not aware of either the one that you pick have an economic mode or not, I would suggest you go to index fund or ETF. Make the process easier, and also at least if you just ensure that you have the minimum return instead. Okay? And the third one is you avoid a cyclical industry. So the most significant one might be a beer factory. So when it comes to the beer industry, beer, alcohol, so this is very obvious that during festive seasons, the share price will rise, and after the festive season, the share price will drop. So we want to avoid this kind of cyclical industry. So we just keep on repeat this cycle once and once. You want to make sure that the industry that you select is keep on going up and keep on going bullish, have a bright future instead of this cyclical movement. And you need to identify the current market cycle trend due to the economic view. So if you are not sure about what is the current market cycle trend, it's very easy to tell from the fear and greed index. So let's say your older generation, your aunt, or your uncle that doesn't know about anything of Bitcoin, doesn't know about anything of the US share, at one stage he comes to approach you and ask you to invest into Bitcoin. And at that time, you know that the market is now at the extreme greed, the maximum greed, and that is the very obvious exit point, exit signal that provide to you. When the aunties in the bazaar, the market tell you to just buy on some share, buy on some crypto, and that is the time that you know that something is going to pop up and just go down. One signal given, okay. Be aware of your environment, the people around you. So the strategy DCA is also this is an investment strategy that have a fixed amount of money invested in a regular basis. This is what we call a DCA. Let's say, very normal example is there's two types, a fixed DCA and a flexible DCA. We will go it quickly. I don't think we have much time left, maybe 10 minutes, okay? So the DCA is, in this case, you don't need to be aware of what is the pricing of the current market. Even though you invest at the peak previously, and you keep on investing and investing, even though it dropped for 30%, but in the future, it will go up anyway in the future. So this is the CFD on gold, and you can also look for the ETF on gold. And this is the Nasdaq 100. This is a Nasdaq 100 ETF. Okay, so you can just pick on the similar stock, and then even though you pick up at the top rope previously, it dropped for 38%, you make a losses, but never mind, it will still go up in the future. Okay, so this is the force of the DCA. So you don't need to be aware of the noise in the recent market, and then keep on investing and investing. Eventually, if you just surpass all of your previous positions and give you a better return. So this the fixed DCA is like I keep on investing the same amount every month or every week whatsoever, just the same regular basis. So you can see that in the fixed one, we just keep on investing the same amount in every period. Or the flexible one, in today I might have some extra money, so I will just invest $100, and then maybe next month I have extra money, I will invest 200 and whatsoever. It can be flexible or it can be fixed. So you can see that even though there's up and down, but eventually the whole market is still going up in the future. Okay, and this is about the emotion cycle in the market. So even though you can see there is up and down, but eventually you can just be aware of the average trending is still going up in the future. So you just keep on investing and investing. But if you want to know about all of these states, you can just take a look at the fear and greed index instead. So for today, I believe the fear and greed index is placed on 44, which is at the status of fear. So just check out on Warren Buffett quotations, and then when the market is in fear, what you need to do. That is why that you can just trade it as your own preference. Okay. Here, let's see. Seems like here. And when you go to the use smart apps, and then this, when you go to the S&P 500, you can see that there's a plan, a smart plan for you to able to just invest a fixed amount, a smart plan for DCA. So when you are using USmart, you can make your money work for you, and then keep on investing in the same regular basis without any worry. USmart will do it for you. And this is the way to contact your manager. You can go to your app. At the last tab, there's a tab called Mine. When you click on that, and there's a button called Manager. And then when you click on that, you can talk to your manager for any, if you have any questions. And this is my personal contact if you want to approach me. And on the left, this is the Telegram contact, and on the right, that is a WeCom contact. You can add through the WeChat. Okay, so the last bonus for today's section is, what is the ETF that you can pay attention to? What is the sector and industry you need to pay attention to? So under Trump policy, actually Trump policy only focus on three things. First thing is, you want to make America great again through cutting the tax, and then just reduce the rate for the borrowing. So with that doing so, all the U.S. companies can grow at a very fast pace because they can borrow money at a lower rate and then make their company grow. And among of those sectors, technology companies will take the biggest advantage, because this is like it is about the speed, about the pace. So technology company actually will take the biggest fruit from under that policy. But be aware, because nowadays technology companies all located at a very high level. Okay, you may need to wait for a retracement, or you may just start DCA instead. And the second industry and sector you need to pay attention to is energy sector, oil and gas. So under Trump policy, you want to make energy independent, which means that he don't want America to depend on the other energy import from the other company. So they want to increase the supply of their own local energy. So when the energy supply is getting higher and higher, eventually you will just take up more of the market portion. So when you take up more of the market portion, the company claim will become higher, reputation become better, and then and then eventually they will grow together. So you can pay attention to the energy sector, which is the oil and gas. Okay, we already scheduled that previously, and if you come along with us and you are already making some profit through the oil and gas stock. And then the third one is the aerospace and defense. So aerospace and defense is very obvious. So maybe you can check out something like Lockheed Martin, Northrop Grumman, and they are the top tiers in that industry. Or even though you can just search for the ETF for that specific industry instead. So yeah, I believe that's all for today. And if you have any questions or you want to know about the details, you can feel free to contact me. And let's see if you guys have any questions. If you guys don't have any questions, then we shall end for our session right away today. And yeah, just a little thing. For next week is Chinese New Year, and we will post our lecturing for week, and then we will come back after the Chinese New Year on February 3rd until February 7th. So we will post our lecturing for 1 week, and then we will come back afterwards. And then at that week, I think we will go through the Greek trading, one of the very good robot trading style. If you want to just free your hand from trading in investment. So I don't see any questions from you guys, and we shall end our session right away today. Thank you for joining, and hope to see you guys after the Chinese New Year. Happy holidays.
Recording stopped.